Welcome everybody. Delighted to be back with you. It's the Market Sniper. So here's what we're talking about today. The Fed seems to be doing a whole bunch of rather interesting activities. Let's just leave it there, an announcement. So a couple of things that have happened, and at the same time as these activities have been taking place, we've been getting interesting movements on the yield curve and treasuries as a whole. So what has happened in terms of the Fed, and then I'm going to tie this into gold silver ratio and silver itself in terms of what we think this means and how it's going to play out for the precious metals. Okay, so first of all, if we go over, let's just go to a couple of news articles, why don't we? Fed to allow the emergency bank lending program to expire March the 11th. Now, the truth of the matter is I'm no expert on these plans anymore. My eyes glaze over when they start turning them into acronyms and start da-da-da-da-da-da. I would recommend, if you want to know more on the emergency bank lending, people like George Gammon, who's done a video on this a day or so ago, go and check out his channel on this particular point. Lynn Alden is also top gun for understanding all the specifics of all of the minutia, the acronyms and everything. All I tend to do is manage the macro and go, this was a propping up mechanism of liquidity provision. Beyond that, I tend not to care too much. In other words, it's details, then they can lose you in the weeds of the details. So that's my chosen route. In other words, better people on the detail for this. But essentially, the Federal Reserve was providing emergency bank lending. Then they somehow allowed an arbitrage, free money, free profits to also occur, and they're scapegoating that arbitrage as the reason for why they will be withdrawing this. This is a great way to cause panic in the repo markets of banks lending to each other. You see, when the central bank, and I'm just top line, top of the mountain, reading from the canopy of the trees below. I'm not getting into the weeds and mushrooms at the foot of the trees here. But essentially, when you have the Fed participating in a bank lending environment, banks are okay with lending to each other. That is the repo market, the interbank lending. That's where the phrase LIBOR comes, the London Interbank Lending Rate. And of course, so America came up with their own version of that and have delinked from LIBOR, but essentially it's banks having confidence in other banks when they have excess reserves to go and get a bit of interest on that money overnight, and banks that are tiny bit tight liquidity wise borrowing that money. And it's a very important part. You are not going to get repo market problems if the biggest bank of them all that can create as many dollars is also participating and providing emergency bank lending. But why did they need to do that? You have to go back to when they introduced that. And that was because of repo rate concerns. Because somebody's thinking, one of you guys out there is a Lehman. Because we know there's a whole bunch of toxic, excessive debt out there. And we're going to hang on to our liquidity rather than seek the return on the basis that return of capital is starting to get more important than return on capital. So what they've actually done is they've announced in January they're taking it away in March. Now you're going to see interesting reactions by the participant banks potentially here. They might all feast now and make sure they stock up on liquidity in this program. So actually the use of the program might go up, or they might start tapering their reliance on it away. But then where will that additional liquidity come from? They're going to rely on other banks providing it to them, and if there's insufficiency or there's loss of confidence in any way due to the debt system, the proliferation system, etc., you're likely to have problems. So this particular article on Reuters, and we'll pop the link in the show notes for you to read a little bit further, but that's one thing that occurred. This occurred recently. So this is dated the 25th. We're on the 30th, so 5 days ago. Then, literally yesterday, 29th, the US Treasury announced they're only going to borrow. Only. Note how you create an only, and this is a low number. First, you set an unbelievable number that's heading for $1 trillion. Deep in the 800s it was they were seeking to borrow. and then you mildly undershoot it and you're overperforming. So I'm going to say it's kind of like you need $100 to buy, or let's say $500 to buy a cool pair of trainers. And you go to your dad and say, Dad, I need $2,500 to buy new sport equipment. And he goes, $2,500? And then you say, and a little bit later you say, Dad, I've done some hustling and it seems I'll only need 1,800, and the shoes cost 500, and you're sandbagging him basically, and he's like, whew, I've saved $700 there, because you shock on the high side to make 1,800 even sound like, wow, thank God it's come back a bit. So this is essentially overstate the requirement, then overperform to a chronic overstatement, and you're doing a great job. You're really working it down. It's kind of like the people that have products that they say 90% discount, which are 1,000% overpriced, just so that you think, wow, I'm buying it for 10%. It's just fluffery and fraud, basically. Anyway, so the US Treasury is going to not need to borrow. Well, that's ambitious, but they know the effect this announcement would have on the debt markets. So the debt markets that are in fear of the amount of proliferation that is needed in terms of the Fed's activities was pushing the market up on rates recently, and of course the valuations down, now goes, oh, so awesome, overstated chronically, and is actually going to overperform to that overstatement by coming in under. Let's all buy the bond market. And so the bond market is actually getting a bit of a bump. So now we turn to the bond market itself. And for that, I'm going to take you to the charts, because as I said in the live stream earlier, but without charts, on a slightly windy beach, that apologies, we do the big cat, the hairy cat mic and all of that. And I had to eventually move into some shelter there for that one. We care about audio and quality there, but we like also to report to you from the field as things are happening, wherever it may be and under whatever circumstances. So sometimes you just have to bear with us. But doing in a more controlled environment, this is the charts that go with what was said in that video. And this is the 30-year minus the 2-year yield curve. So what you've actually had in the blue box, a yield curve reversion back to positive. Now, of course, because of the article and the news announcement of undershooting yesterday, they've actually managed to get this 30 and 2's yield curve inversions to dip marginally negative. To be clear, it's minus 0.025%. Minus 0.025%. Okay, well done. It's going to be back over the blue line in due course. But while this overperformance to a chronically overstated need for expenditure and further debt issuance is worked through the system, and it's much how they manage the non-farm payrolls as well. They, they get the banks to understate hopelessly the non-farm payroll number. They overperform to that number. Everybody, woohoo, that's awesome. And then 3 months later, they restate it probably below their expectations. There's been most expectations have been restated to the downside in the labor number. So it is actually a cunning game of expectation management. Expectation management, and you want to watch out for that. And they get the analysts in the other banks, they give them guidance on how they should set their expectations so that they can play this game. So it is pretty much a bit of theater. Anyway, yield curve reverted positive extensively and is now dancing either side of the line. What we highlighted to all those that know our particular TA is that you had a left shoulder, we refer to that as armpit 1. You had a falling wedge here, right shoulder, which you broke above here. This is a technical break now, even though it's feigning back and chopping around the line. And you actually had also, let's fatten this up a little bit, you also actually had your W head, which in its apex, by the way, was an M as well. So you actually had in there like that, which actually performed to its downside target. which gave you a soft neckline there, which happens to be, where your falling wedge fell to. All that stuff we do with key levels of significance, so random, so coincidental. Localized bump happens to resist at this level at 0.4. Key round numbers. Another coincidence. You know how it goes. You all know the routine. Lots of coincidences when you're using HVF method to do TA. And there was the target performance of that M downside, for which you only dipped a little bit lower. So you have a W head, which is kind of like a W bottom, but you also have two shoulders, and those shoulders interacted, particularly the most recent one, to your key soft level that you got both necklining on the M head and your falling wedge point. And since then you've popped up to here. So yes, short term, I actually think there is scope for this to dip again. Don't forget, even on this shoulder, there's two fractals to it. Note the flag we drew there as well, by the way, which saw the next down leg. You still got a rally, but then you got the broadening structure, which is ascending on a bear sell-off. What do you expect? Downside continuation. We're the only guys with broadening structure theory. We've written the book on it, literally written the book. It is written up. But you see, you still had a complication, a small fractal of dip and a up, and then you got your right and shoulder. So actually you've got two dips below the line. Note how you tested and just ran. Key levels of significance, just run, bounce, just run, bounce, then dip through, weak bounce and spill, dip through, now resistance. This is the classic dance around the key levels of significance that we teach daily and watch and implement, and makes for proper entries using limit orders, not market orders. Anyway, enough on that, but you can see you actually inside the pink shoulder that I drew here, you actually have two little moves in and around the line. So it's quite feasible for you to get your big shoulder and then you get a little shoulder of some form. It often replicates as above, so below, as left shoulder, so right shoulder, and so you can watch. So this projection gives you a very strong positive level that takes you back to normalization of yield curve, which is when the crisis occurs, which was the point that was being made in the previous video. So you've recently had, let's just dot join here. And as I say, go to the specialists, read the articles in the links provided below, and then go and check out George. Will deep dive you a little bit further. But for me, the top line macro understanding is all I choose to need, because there's other things that need to be watched. You've got to choose your energy and your battles for how deep you get into the weeds. Essentially, it's a liquidity provision program is announced early, probably unnecessarily, that it won't be continued. Going to cause repo market ructions. That's going to turn out a bad idea. At the same time, to support the bond market, because they need to support the bond market, declare simultaneously, literally within days, you're going to undershoot your requirement that you probably hopelessly overstated, just so that you can overperform to the... It's like kind of say, I really want to, I'm going to make sure I make my high jump. Please set the bar at 5 centimeters off the floor. And then I go, wow, see how I flew over a meter more than there was needed on that. Aren't I an amazing jumper? And you will look at me for my minor little hop that I've just put in and go, I wouldn't categorize that as an amazing jump, dude. But anyway, keep fooling yourself. So there we go. So that's our complex head and shoulder. And this is the first of them to revert. However, please note, as we said it's reverting, it pulls back. So when you overcome a key level of significance, naught on the yield curves is ultimately super significant. You're going to dance around it, and you have the possibility, like you had that dip below and rejection, you'll have the dip up and rejection. We refer to this in our phrases of breakout as the break and feign back in. But do not be fooled about the overall general direction of the yield curve, hence why we have put everyone on trigger alert stage now. We are in the zone that once once the reversion has reverted back positive, the yield curve inversion has reverted back positive, and it starts to do so on the other yield curve, and we explain 10 years minus 1, 10 years minus 2, 30 years minus 2, 30 years minus 1, 10 minus 6.5. you name it. Eventually, all of these will revert positive. This is the first, which did yesterday, currently back below. And that's why you should be on red alert for counterparty risk, banking risk, repo markets pain, interbank lending pain, particularly as you just have the biggest bank that's the only one that supposedly can't fail, that brought confidence to the interbank lending market by being a lender itself and participating in the mix and being on one side only, liquidity provision. Guess what? Everyone felt pretty calm about banks. That's why we're not having bank dramas. Pull that at the same time, and now they're trying to keep a bottom under bonds with this news. And then you look at the technicals, the drama is coming soon now. So we've referred to demand destroying event. This already is the longest in the modern era, since the 80s gold run, the longest. Here was when you first broke in full below the zero line and never held above it significantly again. That was 2nd of August. My apologies, it's not 23, it was 22. I want to correct that annotation immediately because we like to be accurate. And then all the way through, these were rejections, armpit 1. This is your W head with a smaller fractal M head, rejection, rejection, all the way down again. And this is the longest inversion of a year, 6 months and 10 days. And that's when it first put its nose back above. Again, feign and break, but that is a break. It's the beginning of the triggering event. Now we draw the line from there. There we go. So 12th Jan 24. That was when you popped above. That is a triggering event. You got a close on the 3-day chart. By the way, I'm on the 3-day. It's not even a daily chart. You got a close on the 3-day chart above the zero. That had not happened since that candle. Please observe with me. Not happened. These are on the line, on the line. That is above. That is also above. So you had 2 in 3 days. So that is a triggering event. It is now a trigger. The probability of the upside becomes higher, even though it's feigning back in. Break and feign stage is the beginning of the breakout, even when you come back in. Okay, so that is some technical updates from yours truly on the yield curve inversion, and this could mean counterparty risk. You got to own your own certificates on equities. If you're choosing to hold them long term, we could have a disinflationary event. You could be too aggressive. Those that have been uber bullish on the stock market, by the way, we've said inflation will inflate the stock market. The inflationary part of the global stagflation we are in will inflate the stock market generally as fiat is being proliferated. However, beware the demand destroying event, which could see a violent pullback. That possibility has increased in my mind on balance of probabilities following this event, and you are now moving closer to the point where that could happen. Don't forget, S&P at all-time highs, many other indices, US indices, doing swimmingly well right now. Caution, if you've had a good run, maybe you want to think about that. Okay, that's it from yours truly. Oh, no, hold on. I apologize. The most important bit is the gold and silver market and the gold-silver ratio. So we've been talking for an extended, this is monthly, we've been talking for an extended period around this particularly. And I might even take my annotations off here for a bit, just for it to pop a little bit better. This grinding up attempt to go higher that is proven so weak, that channel. Now, apart from the reverberations and bounce of the volatility that came with that crash down, we have been, since this month here in 2023, I will tell you which one it was pretty early in the year, for the better part of a year in March, we have been trading inside a channel range, and it looked like we'd broken it. In fact, you did, to a wick level. Remember, we wick trimmers. What you're actually getting right now on a monthly candle, and we have another day to go of this month, is actually a big rejection after making a marginally higher high. You will know we use these phrases quite often. Big rejection after a marginally higher high. And this right here is, you guessed it, a shooting star. At the top end of the range of a channel that's been in existence for about a year. So to me, that's significant. What we're also seeing here is, whilst gold is sort of benign, silver's been reasonably strong. So let's wipe our face. Here's a falling wedge. By the way, in a previous video on a pullback, we said expected the silver to potentially meet the $22 mark. Look at what it did. Go watch that video. It's in our history where we were talking about gold and silver. Silver to run the 22 and then bounce. That would be a potential support point. It did exactly that, by the way. And if I take you to the 3-day, we can show you how this has been a soft floor, $22, for an extended period. Throughout this continuation pattern, 22, 22, 22, 22, 22. You get the theme. Resistance 22 on the one spell of great negativity where you got below resistance. This pretty much an anomaly, support, support, small dip through, support, support. The 22 level is important. You had a falling wedge with an extended second impulse, now triggering a break on the after meeting and falling into the 22 level. So let's just have a look at that in bigger view for you. Very, very nice triggering break. You can get a return move, by the way, especially if bonds are going up. Well, many people will say the interest rates going down will support gold and silver. I actually think once everyone has lost full faith in the financial debt system, that's when we're going to get our true recognition on gold and silver. But this could pull back before going higher. So silver right now outperforming gold at the moment, hence why gold-silver ratio pulling back. I'm going to put the lines back on and allow us to see all the detail of the draw, and we will go one more time just for everybody's sake. We want this level around about 82 to get broken and point to the downside. So now you're seeing this on a slightly lower time frame. That's your rejection out of this channel. That's a channel you moved into. I think that was the wick 20th of March 23. You've literally been 9, 10, we're in January, the end of January, going for 10 months inside this range. Many people will say, not again, you call this, not again, whatever. We'll keep watching this and we'll keep saying, could this be the one? Could this be the one? Could this be the one? Could that be the one? We've had a few recently. So it's really tapping itself out on the high side here a number of times and falling. It's not falling gangbusters, but what I can say at the moment, what I can say, because this week is still new, it's only one day, that was a rather nasty rejection. Note how it come very close to 92, just took that high, and then you're being rejected down. That's what we're highlighting. That could mean support for the risk, and you're seeing the falling wedge bounce on the silver. Interestingly enough, that even shows us or leads us to believe that Bitcoin would have a good run. We had a squeeze and a run there. Also an anti-fiat. I consider the precious metals above that in terms of godly status, but an inverted head and shoulder here, complex left, shallow right, took a while to get going. This caught me almost by surprise, I have to say. I wasn't expecting that. I just bias long in bull markets, and I was a bit concerned about it. Playing footsie at the 42k level, this was a very shallow shoulder, so sometimes where you don't do enough of an exhaustive sell-off on the shoulder, you then stall and splutter, but eventually you got nicely going on that for a run up there. However, just a small warning for the crypto kiddies, and this is not a crypto channel, bit of a broadening structure. You might get a rest back down at some point. So you're having, a pump in there, you had a kind of pump in there, you're getting another pump in there, each time matched with a sell-off. You could have another sell-off, at least to the splitter, with possibly a bounce, and you could go further, or a bounce and then you go back up. But generally I would not treat this as good entry points for those that aren't in. Okay, so you got an update on gold and silver, the gold silver ratio. Did we look at the gold chart officially? I don't believe we did, so let me finish on the gold chart and remind everybody where we are. We are essentially languishing near highs, and we have suggested to you that is going to be an amazing structure. And if that gold gets going and the gold silver ratio does continue to head down to the other side, silver could be a very attractive buy right now. You've got the likes of Rick Rule talking about it being the most hated market right now, like uranium was a while ago, silver equities, etc., etc. So look at that sort of W upside down bat's head, W bottom with a bit of soft necklining there as well, pointing very much to a likely third impulse up top here above the 2045, and then we break. We make new highs out of this structure. Listen to me now. You're hearing it from the market sniper. In the event of making a move higher to in and around the 2050 and just beyond levels, it is my expectation that any subsequent pullback from these levels should be bought potentially on limit orders for an upside break to the upside. We explain in our community, which you can check out on the first link below in the details, how you would put an order on that and where you would take profits and how you would manage high risk reward trading. Okay, that's it. Thanks for watching. We'll catch you again later. Blessings, play it safe, non-advisory as ever, and we appreciate the likes and the shares. Bye for now.